Hey Jesse, great having you on the show today. Welcome to the Howzit Networkers.
Hey Mel, great to be with you. Thanks so much for having me.
Fantastic. So this one is specifically really exciting for me. We have got you guys from Homewise on board personally. You guys are doing our mortgage. We've had an incredible journey. Your team has been fantastic in terms of us buying our first property. And I just had to get you onto the show to say, let's have a look at what this process contains. What does it look like? Simplified for immigrants coming over and wanting to start their first property or having to be here. And what does it mean to be in a work permit and those kind of things. So I'm going to go through that. I want to just maybe start at the basic and tell me a bit more about Homewise, your team, and those kind of just a bit of background.
For sure. So number one, great to have you as a client and as a partner. It's been a great experience. So our goal at Homewise is really to simplify the mortgage process. Mortgages are confusing, be it if you've been in Canada for 25 years or if you've been here for 25 days. The process isn't cut and dry. We have different financial institutions like banks, credit unions, and monoline lenders that you could try to go to on your own and try to figure it out. But we really simplify it. Our clients apply online in about 5 minutes. And then we actually work with over 30 lenders, from banks to monoline lenders to credit unions, and find our clients the best mortgage options specific for their needs from these lenders, based on what's the best rate, what are the best features, and who's the best lender specifically for what they're looking to do. Then each of our clients are actually set up with a personal advisor from our team that takes them each step of the process from there. One of the keys, though, is that our advisors are completely unbiased. We don't work for the bank, we work with our clients. So they just try to provide the best advice possible to our clients so that they make the right decision for today, but also because home buying is a long-term decision for 3, 5, and 10 years down the road with their mortgage. So we always say it's faster, easier, more transparent than ever before, and often we save our clients the most money possible in their mortgage too.
Absolutely. We've had that exact experience, and just the process of it being daunting, having a property in Canada and understanding simple things like when you buy in the countryside or whether you buy downtown, what the process would be, what questions to ask, what to look out for, because the process is very different from what we would be from coming from South Africa, or you could be from anywhere in the world. The process in Canada is different. So I want to take it a little bit back and kind of go for the South Africans. We start with things that words just that's really different here. So I picked up a few. Don't know if you've got many, because you speak to many. You've dealt with a few South Africans, and you even have you've got some South African roots as such as well. You can tell us about that one.
I guess my daughter is half South African because my wife is South African. So my wife is from Johannesburg. She moved here when she was 9 years old. So I'm part of the South African posse, I'd call it. I use the word Leka a lot.
Well done.
Everything's quite nice. So it's definitely been great to meet more and more South Africans since I met my wife.
It's cool, man. I like your wife already. If she's from South Africa, she's already, amazing. So so in Canada, we talk about a mortgage. We don't talk about a bond. So you get that. We get words like, I've seen recently someone talking about they're just finishing off their skirtings. It's not skirtings. It's baseboards. Another words that I picked up is geyser. It's not called a geyser here. It's a water heater. Cornice, called crown molding. I don't know if you've got any couple of words in your industry that's kind of flowing around that people don't really know what that means, and it's got a different word for it here.
Yeah, the thing about mortgages is there's a lot of terms that even if you're not from South Africa, you don't understand in Canada. Fixed versus variable rate mortgage. Sometimes it might be confused what that means. There's a term called a collateral mortgage that I ask 99 out of 100 people don't know what it is, and that one person who says they know what it is, it's because they work at a bank. So there's a lot of terms when it comes to mortgages that it's important to know. And I think let's start with what a mortgage is, and then maybe what a fixed versus a variable rate is. So a mortgage is basically exactly what you had in South Africa, but luckily the rates are much lower here. Where in South Africa, the rates might be 9 to 12%. Here, they're at the current rates, they're anywhere between 2 and 3%, and sometimes even lower. The way it works is the bank will give you money, and the mortgage is put against that, and you'll pay that off over generally a 5-year term, and an amortization, which is the full length of the mortgage, of anywhere from 25 to 30 years, depending on the size of your mortgage and the down payment you have. In Canada, you could put a down payment as low as 5% if the home purchase is below $1 million. If it's above $1 million, you need to put down 20%. Having said that, if you do put down less than 20%, you'll have to pay something called CMHC insurance, which is roughly anywhere from 2 to 4% of the price of your home on top of your mortgage. Talking about fixed and variable. So the reason those are different is there are two different ways of looking at an interest payment. A fixed rate means that the amount of mortgage, which is, let's say, a $400,000 mortgage, a term that we call it here, you might call it the same in South Africa, is called principal. So your mortgage principal is the amount you actually owe back to your bank. On a fixed rate mortgage, on a 5-year term, that's your contract length with your lender. On a fixed rate, the same amount of interest and principal you pay off over that 5-year span will stay the same. So let's say your interest rate is 2.5% and your monthly payment is $2,000. You're paying exactly that amount for the full 5 years, and the amount of interest and principal you pay down is the exact same. The difference with variable is usually variable rates start a little bit lower, but the amount that you pay off of your principal could change based on where the rate goes. So if the rates drop, you're actually paying off more of your principal. The amount you pay every month doesn't change, but the amount the principal might change. However, if rates do go up, the amount of principal you pay off will get lower. So on renewal, you'll have to pay more money. So those are the real mortgage basics. The reason that people choose fixed is just, you know exactly what you're going to get. You know what you're spending over the next 5 years. And if rates go up, you're not in a bad situation. The reason people choose variable is generally over the last 30 years in Canada, if you chose variable, you saved more money. Having said that, it's for someone who really understands macroeconomics and understands the market and understands the risk involved. And that's why we always just try to explain to our customers as much as possible.
I think it also, you look at the situation completely from beginning to end, and then based on those recommendations, you would give the best rate, which is exactly why this process then, you take care of that kind of headache of looking at that. So would the process then be different if I'm going to be on a PR versus a work permit? I know that the kind of questions that I had is, can I, number one, can I get a property immediately when I land? Can I buy when I'm still in my country of origin? Those are the kind of questions. And penalties. Talk me through what that looks like on a work permit versus that, as well as wanting to invest in property before I've even come over.
Yeah, so let's talk work permit versus PR. So if you're on a work permit, what's great in Canada is we actually have new to Canada programs. You'll need to be here for at least 3 months working. So they'll want to make sure financial institutions, the number one thing they look for in a mortgage is lack of risk. So they want to know that you've been here for 3 months. And when that does happen, these new to Canada programs will only work for a home under $1 million, but you could have a down payment as low as 10%, but you would need at least 6 months of your funds going into a Canadian financial institution to show that. If you do want to have 5 to 9%, you might need to show some other products like your credit report from another country, or in South Africa, I know it's a different one, but so the way your credit is scored, and then show some of your banking history, because they want to make sure that you can pay off your mortgage and everything is basically kosher from that perspective. If you are a PR, you're treated the exact same as every other Canadian. You could have your 5%, 20% down payment. There's no crazy bells and whistles. There might be some things here or there that are minor, but as long as you have 3 months working in a full-time job, you're fine. However, even if you are a PR and you're self-employed, you're going to need at least 2 years of tax documents. These are called a T4, T4A, or an NOA. So these are your tax documents that show over the last 2 years what your income has been. Generally, what lenders will do is they'll average out those 2 years' income. So let's say you made $50K one year and $60K the next year. They're going to average that out as a $55,000 income. That's how they'll grade you, both as self-employed and as a commission salary. So those are all things, again, the reason that we always suggest to clients to work with a company like ours is you could get that unbiased advice to say, hey, in your situations, this is what your opportunities are. If you are someone who is new to Canada and you're sort of making money back in South Africa and sort of making some money here, but you can't afford the mortgage you want, there are certain lenders that will allow you to get a mortgage, but you need to have at least a 35% down payment. So this could be, let's say you have an interest in a company back in South Africa where you're making good money, but you're just brand new to Canada. You don't really have your feet set here. There are some programs available there, but again, you would have that situation happen. However, if you are not yet in Canada and you're looking to buy in Canada, there are taxes. So there are foreign buyers taxes that are anywhere from 15 to 20%, depending on what province you buy in. And these are for people who don't get taxed in Canada, don't live in Canada, and buy a home in Canada. So it's always an important thing to consider that if you are looking to buy a home and you might be here 6-12 months down the road for some time, the best time to buy might be once you are either on a working permit or a permanent residence.
So let me just clarify, if you're on a work permit, you can buy a property. Would that property taxes still be applicable to you or not really?
It won't be, no. So if you're on a work permit, you're getting paid in Canada, you're getting taxed in Canada. So you're considered a Canadian citizen from that perspective. Not truly Canadian citizen yet, but from the mortgage perspective, you are. And it's called the New to Canada program, which almost every lender has. And they would just want to make sure that it can be an insured mortgage below $1 million, and that you have at least anywhere from 3 to 6 months of time working in Canada on a full-time job, and that you just follow certain qualifications they're looking for.
Oh, okay. That makes a huge amount of sense in terms of understanding where do I need to do. I know for us, what we did is we approached you guys a while before we started looking for a property. And that's something that you can do in South Africa as well, or in your country of origin. It's just understanding what the process was. What helped us, we did this about 6 months before we started the process, is when we started looking, when we got in touch with you and we had a look at what we did, you made certain recommendations to say where you are right now, this is what you can look at, and this is what you would need to get in terms of where you want to go for buying property. So we could get certain things in place knowing when we are ready. We've built that relationship and we know what documentation or how do we set up our tax situation or whatever it might be, what we needed to do so that when the process starts, because buying a house here it's a process like this. You happen to, once you put the offer in, within 24 hours or stipulated time, you need to put down your check, your deposit check, or a portion of that as proof. So, and that was something that needed to happen quite quickly. So it helped that you've got that relationship with someone that understands that. One of the things that we are used to in South Africa is you would have a relationship over a period of time with your banker. So you could go and sit down and you could say, hey, John, you know what, we've been, chatting for 20 years, you know my situation. Now let's talk about getting my bond, my mortgage for buying a property. That's not the case when you're just a new immigrant coming into Canada, because you do not really have that relationship. And that's where it really makes it really worthwhile speaking to someone like that, like you guys, that Homewise have done the work. They have got the relationship with everyone. So they are, you are independent. You're not, you are really looking for the best deal for your customer, which is what we've experienced.
Right, and so great to hear that story, because it's funny. You say new to Canada, don't have a banker, but the classic millennial doesn't have a banker as well, because we just never step into a bank. I always joke when I got married a couple of years ago, I went into the bank because I had to do the whole thing with my wife for checking accounts and things like that. And that was my first time probably stepping foot in a bank in almost 6-7 years. And it's a really interesting mentality. What you were talking about is something called a pre-approval. So a pre-approval is something that's really important in the process, because you would come to us, we would tell you, hey, you know what? You might be ready to buy today. Awesome, let's go forward. Or what are the steps you need to take over the next 6 months to get there? And what that does is it really establishes that level of comfort. You could go directly to a bank and you could say, I'm going to go to this one location. What we always say to people is, if you could go to a shoe store that only had one pair of shoes on your wall, would you rather go there or to a shoe store that had 30 pairs of shoes on the wall? And the person who works there isn't going to try to push you into one option versus another. They're going to give you all the options you want. So that's generally why we always say we love the opportunity we have with our model, is because we say to our clients basically, here's the advice you need. You're not locked into anything. You don't have to only use our one solution. And when it does come time to when you want to actually get pre-approved or in the end approved, we'll be able to find the best solution specifically for you at that time and set you on the right step to make that decision. Because I know for me, I was probably a horrible buyer when I worked with my realtor and my original mortgage company I worked with. It took me 4 years to find my home, and it was a lot of back and forth, wrong decisions, right decisions. I wish I bought the home at the beginning, but I unfortunately didn't have the right mindset in buying. So it can be really fast, like it was with you, or could take a little bit more time.
It could take a while.
It's really good to know what steps you have to take and where you are right now, because you never know where that might change 6-12 months down the road.
Absolutely. So based on that, in terms of a first-time home buyer, if we are talking about myself or someone that's kind of landed in, what benefits do you really get? Are there specific benefits for newcomers?
Yeah, so first-time home buyers, the way it's generally noted is someone who hasn't owned a home over the last 4 years. So even if you are new to Canada and you owned a home before, there's a certain amount of time between that time. You're good to go, and you can take part in these new first-time homebuyer programs. So there's 3 different programs. The first one is called a shared equity program. I wouldn't really suggest this to too many people unless they needed it. But basically what the shared equity program is, through the Canadian government and the CMHC, which is an insurance body, if your household income is $120,000 or below, and the home price is generally below $520,000, they'll actually make a co-investment with you into your property between 5% for a resale, so that's a house that already existed, or up to 10% for a pre-development. And it's not free money. So if it's a $500,000 place, they're not just giving you that $50,000. They're making a co-investment with you. So if you buy for 500 and sell it for 600 and they put down 10%, they're going to get 60K back once you sell your property. So it's a good program for individuals who might be tight against the ropes when it comes to their down payment, but it's one where you really have to decide, is this the right decision for us and me in the process? The second one is actually a land transfer tax rebate. So coming to Canada, we have a lot of awesome free stuff from the government, but a lot of the money comes out of our taxes. And one of those taxes is a land transfer tax. So when you are buying a home, land transfer tax is generally a percentage of the price of your property, 2 to 3% of the price. And in Ontario, as an example, there's a $4,000 land transfer tax rebate. If you live in Toronto, I think I might be slightly wrong with this number, but I believe it's $4,750 that Toronto on top of that gives you as a land transfer tax rebate. So
big amount.
It's a big amount. And if your land transfer tax is $10,000 and you bought a home in Toronto, you might have just saved a good sum of money. So that's another really strong incentive. The last one, it might be a little bit tough. I don't know exactly how it works for new to Canada, but RRSPs, which are our retirement saving bonds and plans that we have here, it's non-taxed in Canada. So if you have been here for a couple of years and you start to build your RRSP in Canada, you can actually take up to $35,000 per person to put that towards your down payment. So this is untaxed dollars that could go towards your down payment. So those are 3 fairly strong programs that we have in Canada. The number one that people care most about is the land transfer tax rebate, while the other ones are nice value adds for those who are interested in it.
Absolutely. So, but the thing is that your tax, as you said, your tax money is working for you and you're getting that benefit out of that, which is fantastic. So we need to go back into credit history because for us, it's a big thing in terms of building you need to build your credit score that they call them here. How important is that? What if you don't have one? Okay, how do you build one up? And what do I need to bring some documentation from my country of origin when I'm fairly new and I buy property? Because you'll build up, when you're here for a period of time, you'll build that credit history, so they'll take that. But take us through what that looks like.
Yeah, so credit score is very important for your mortgage. Lenders will look for at the very least, about a 620 credit score, preferable to be 650 to 720 plus. And the way you build up your credit score in Canada is, don't just come here and say, I'm going to get one credit card and I'm good to go. Having multiple lines of credit are important. So that could come from your phone bill, your credit card, internet, whatever it might be. And the reason that one line of credit is not great is because lenders want to see your credit history and they want to see that you're quick to pay off your bills. You can do it fast. You don't take out too much debt. So I know if you go to a hockey game in Canada, there's oftentimes get this free t-shirt with your credit card. Don't do it that way. So don't take out too much credit, but do it in a smart way. Pay it off on time. Don't borrow too much money. So that's a great way to start building your credit when you get here. And highly suggest to anyone when they first land here, just start to build on day one. Of course, there are situations where you're coming from another country and you don't have credit. So what will happen in those situations is lenders will look for at least 6 months of you're getting income in Canada, it's going into your bank account in Canada, and then you could look into using some of your credit facilities from a previous country. So depending on where you come from, especially places like South Africa, United Kingdom, US, there might be credit scores, FICO scores, whatever it might be, different credit forms that you could bring over here to say, hey, here's how I paid off my bills in the past. Because you are new to Canada, they do understand that. So in the new to Canada programs, that is understood as part of the process. And it can be discussed with someone on our team to help you understand the intricacies of that. But overall, our suggestion is start building credit nice and early. And if you do have a 16 to 18-year-old child, it sounds horrible.
Let them build that.
Build their credit as well. Get them a credit card, and get the credit cards under their name. Get their phone bills under their name, because as much as it might be terrifying to think they might be going out at night with a credit card of their own, it's a really important thing to build up their credit over time.
It does make a difference. It really does. So you know what, you're going to get that information, that credit history. You might as well just bring it with you. Get ready and understand how to build it up when you get here. Don't wait a few months, as you've said. Just get into it. One of the things which I struggled with is, when I buy property, your first question you get is, how much do I qualify for? Because you are the reality in Toronto is that if you buy a property under $1 million, you're fairly lucky. And then you go into the countryside and you could get properties for as low as $300,000-$400,000. So it's vastly different. But the first step that you need to do is understand what is that amount that you qualify? How do you go through that process? Where do you help the guys with that?
Yeah, that actually comes down to the pre-approval. And what the pre-approval process does, now we talked about it a little bit earlier, is we'll take into account what your income is, all that information from debt to income to payments, and those are all weighed together. So the number one thing lenders are looking for when it comes to affordability is that your income to debt ratios are in good order. So the less debt you have, the better off you are. Yes, some people might have a car lease. It's part of life. But try not to have any other major debts as part of your overall financial picture, because it does hit against your affordability. In the most basic, horrible math, don't hold me to it. Don't use this as your calculation if you're looking to buy a house here. But one of the things that lenders will look for is, if you have zero debt and let's say your household income is $100,000, it's generally you could afford a mortgage of 4.5 to 5.5 times your income. That's if you have no debt. So if $100,000, let's split that down the middle and say 5 times, you can afford roughly a $500,000 mortgage. The other thing to think about, though, is your down payment. So while that's your mortgage affordability, you have to think about what your down payment is. So as mentioned off the top, if you're buying a home over $1 million, you need at least a 20% down payment. If you're buying a home below $1 million, you could be as low as 5% to as high as you'd like it to be from there. So that also leads to your affordability, is think about how much you want to put down as a down payment. As we talk today in Canada, rates are extremely low. They're ranging around the 2% range, which if you find a really good way to invest your money, you're going to make a lot more money back. So it is a good time to borrow more if you're interested in doing that. But if you're someone who doesn't want to have debt, it's also a time to think about how big your down payment can be to increase your affordability as well.
Absolutely. We've had first-hand experience right now where we're saying the interest rates are so low that we can actually afford a bigger mortgage, but the deposit might hold you back. So that's the thing, is what if you don't really have the 20% deposit and you're buying a property? Are there any programs that would help in terms of that? And what's your recommendation on that?
Yeah, so if you're below $1 million, you're fine, because you could put down less than 20%. There is that CMHC down payment program for the homes of $520,000 and below, where they'll do that co-investment of anywhere from 5 to 10%. But the key is, if you don't fall into those categories, you might have to lower the amount of home that you're looking to buy, or just work on increasing your salary. Buying a home is always the dream, but sometimes it might take you a year or 2 years to increase your household income, decrease your debts to getting to that level. So it's also a matter of buying when the time is right. One thing too with many people who move to Canada is nowhere does the saying location matter more than places like Canada, where people always say we're the second biggest country in the world. You never really know the exact size, but let's say we're the second biggest country in the world. We're very centralized to 10 major cities.
Yes.
So that's really something you have to consider is what's the location that you want to buy in? What's the demographic there? If you have a young family, are there schools in that area? And those are all things that you should really take into account when buying your home is don't rush into it. Think about where you want to buy, if it's the right situation. But also think about property value. If you, in Canada from 2005 to 2013, property values basically doubled over that time. So, and it's not going anywhere but up. For the property values continually go up in Canada, again, because there is just so much space available in these major cities, and we have hundreds of thousands of new immigrants come here every year, and millennials are starting to buy homes. So that's another thing to really consider in your home purchase is not just your affordability, but where is the right place to buy.
Absolutely. We've seen something which is interesting in this time that we've experienced is that property in the countryside has suddenly, the value of that is increased where significantly in areas, if you look at Toronto, you're looking at Muskoka area, all that side, up further east, that in some cases they've gone up in value for 25 to 45%, purely because people are moving out to the countryside. They don't need to be in the city. So that whole market is changing as well. What are you experiencing on that?
Yeah, there's been this rush to the cottage over the last few months. It's interesting. And I'm a little bit pessimistic on how much growth there will be on the outside of major city marketplace, because there's a lot of talk right now of online, everything's going to be done online. There's going to be not going to be a lot of office space. So I think one of the really important things for home buyers to do is to find a really good realtor who could give them a view of the full picture, understanding where the market is now, where it's been in the past, because especially in a place like Toronto, and it's happening all over Canada, but especially a place like Toronto, we very much get into these hot periods where there's trends, there's things that happen, people follow the market. The cottage market, and I know there's not cottages in the same way in most other countries around the world. So our country homes up north in the country area, it's been really hot, and a lot of people are starting to move to the outskirts of Toronto. And I think we're going to see a trend in that area. But it's really important to think long-term in your decision criteria in buying. So to think about what is the area we want to be in today and in the future. So it's interesting. I read so much about that, and I'm so interested to see where the market's going to go, not just this year, but next year, because I think everyone's just fearing the apocalypse, and they'd rather be on the outside of it. And because we are talking during COVID times, just in case anyone's wondering. So that's another thing to really consider is where you want to be and what point in your life are you in. And Toronto driving is busy, and
it is something else. It is something that you cannot explain to people how busy it really is, and the traffic is something that you need to get your head around it. But the good thing is that the transport system allows for you to be, if you want to be in the countryside, if that's where you want to be, it allows for it from a safety perspective, and it allows from a transport perspective, because you can get into the city. You might find certain places more difficult to get in, but that's where you kind of need to have that good realtor that you're talking about to get you into that area.
Exactly. And I keep on mentioning Toronto because I'm in Toronto, but you might want to live in Oakville and Brampton and Hamilton, in Ottawa, all areas surrounding, and that's just Ontario. We're not even talking about Edmonton, Calgary, Winnipeg, Vancouver, Victoria, Montreal. Like there's a lot of major, incredible cities. Or if you want to have an even better life, you live on the East Coast in Halifax. But it's a really interesting one, and it all comes down to what your plans are. And if we have on my team, we work in central Toronto. I have people on my team who live in Hamilton, who live in Brampton, and you might not know any of these names, but Hamilton's about an hour and a half out of Toronto. Brampton's about 45 minutes out of Toronto. Pickering is about a half hour out of Toronto. And if you have bad traffic, that half hour could turn into an hour and 20 minutes. So it's just a matter of where you want to live. And again, to Mel's point, finding a great realtor. We work with many great ones, and I know Mel does as well. So it's finding that right realtor for your specific needs is important.
Yeah. So you just spoke about long-term and understanding that process. One of the things that I want to ask you is about how does it look with your mortgage periods in Canada? What is the average? Does it vary from individual to individual? And what do you kind of recommend the term to be to get the best benefits and rates? Is it related to each other?
Yeah. So people confuse the term And amortization. So I'll tell you what the two differences are. So amortization is the full length of your mortgage. If you're buying a home below $1 million with less than 20% down, your amortization can only be 25 years or less. If you're buying a home below $1 million and put down 20%, or above $1 million and put down 20%, your amortization could be up to 30 years. And they're thinking about adding more years to it as well. We'll see what happens in the future. So that's the amortization length. That's the time to pay off your mortgage. The term is the length of your contract with your individual lender. So when you work with us, we work with multiple lenders. Whichever lender that we place you with, that's the length of the term. On average, people choose a 5-year term. That doesn't make it right. It doesn't make it wrong. Terms can be 3 years. They can be 2 years. It can be 1 year. It depends what you're looking to do. So for me, my mortgage is up next year. I'll obviously be going to Homewise for my mortgage. But at that point, I don't know how much longer I might be in this home because this is my first home. I could be here for another 5 years, but I might only be here for 3 years. So I'm going to have to decide at that point with my mortgage agent from my team to say, okay, you know what, maybe I want to do a 3-year mortgage, because if you do have to break your mortgage early, there are penalties. So there are penalties to be paid. If you go to a large bank or a low rate lender, so there are low rate basic mortgages, your penalty might be higher. So those are things to really consider in the process. Is where are you at that point? If you're like Mal, who just bought a new home, you might not be leaving after the first 5 years. But it is important that in Canada, 6 out of 10 home buyers break their mortgage before the 5-year mark. And that could be for whatever reason, such as selling your house, moving to another city, unfortunate situations like divorce, death in the family, whatever it might be, cause people to break their mortgage. So those are important things to take into account when considering the term and the length of your mortgage.
Is it just out of interest? It is a significant amount if you cancel your term. Is it something that you really need to look at in terms of what that would look like to
Yes.
add to risk?
Yes, 100%. So I'm a big bank. If you Google an article right now that says $30,000 fine, I don't want to say who the lender is, but this person had to pay a $30,000 penalty to break her mortgage early. And with large banks, or for even monoline lenders and credit unions who have those, it's called a no frills or low rate basic mortgage. They generally offer a slightly lower rate, but the penalties are much higher if you ever have to break your mortgage. The penalties could be $20,000 to $30,000 if you have to break your mortgage, while at another lender it might be $6,000 to $7,000, which is still a lot of money, but it's a third to a fourth the size where it might be somewhere else. So that's a really important thing to consider. Is that, just to get into that actually, fixed versus variable. If you are breaking a fixed rate mortgage, you're going to have to pay the higher of 3 months interest, or something called the interest rate differential. And the interest rate differential is, if you go to a website of a bank, you might see the rate says 4.8%, but the rate you got was 2%. It's basically the difference of that spread is what you have to owe. So that is why a lot of big banks or these low rate lenders have a large penalty. If you are in a variable rate mortgage though, the penalty is only 3 months interest. So oftentimes if you're like myself, I actually might go into a variable rate mortgage for my next mortgage because I might sell my home. I might do something within the 5-year period. The penalty is going to be lower, usually based on the 3 months interest. So these are all things that we ask clients. We actually ask it in our application how long you expect to live at your property to get an idea of their financial picture and what the right decision might be for them.
Okay, that makes sense to consider that. So that leads on to property taxes. Must be one of the things that you also, when you're buying a property, that you need to consider. There are annual property tax applicable. How's it calculated? Is it different whether you are in downtown Toronto or you are sitting in Halifax, or how does it look? Is that paid monthly, annually? Is there any other taxes and fees like that? Take us through what that looks like.
Yeah, it's different depending on which city you're in. So some cities will be higher than others. Some locations within city will be higher than others. On a $1 million home, let's say your monthly tax might be anywhere from $6,000 to $8,000. And if I remember correctly, I'm not the master of property taxes. I think you can pay it off in 4 increments throughout the year. So once a quarter, you have to pay it off. That's one tax. Again, there's also water and sewage taxes that you have to pay as well, which are much smaller. But those are all things that you have to consider. So you touch on a very important point, Mel, which is when people buy their home, they often only focus on down payment and mortgage payments. They actually don't think about things called closing costs. So when you
Yeah.
actually get a mortgage, you have to consider how much you're going to pay over the lifetime of your mortgage and those taxes. But there's a land transfer tax, which I mentioned more, that comes on close. You're also going to have to get property insurance, which is not super expensive, but it's another additional cost. And we offer it through a partnership. We partner with a couple different companies like Sonnet Insurance to provide insurance. And then you're also going to have to use a real estate lawyer. So your real estate lawyer will be used to close your mortgage. The cost could be anywhere from $1,500 to $2,500, and that gets you your real estate legal services as well as your title insurance. We partner with companies. There's a company called Deeded that we work with that does everything online. So in this day and age when everyone's meeting through small squares, we could do it fully online. So those are some of the costs associated with it. And it's really important to take those into account when you are buying a home, that there's more costs that come available. So don't put all your resources you have into buying a house and leaving yourself in a bad situation potentially once you purchase your home. Leave yourself some money available, because I hear so many stories about roofs having to be replaced within a year of home, and that's not a cheap expense.
Which is exactly what it's such a great process working with someone like yourselves, because what happened with us is that we took it through, and when we spoke to the consultant that was on our account, she said to us, have a look at these costs. You need to accommodate for those, so that we knew what was happening with that. And again, something that they've got in Canada is that once this goes through and you've offered the property, and before the final sale goes through, they go into the property and they have a look at, they assess the property. And so they can tell you what is happening with the roof. They can tell you in terms of snow coverings, your sewage systems. If you've got a well, they'll do a well inspection. So they do these home inspections, and they tell you what will look, what the future will look to in the next year or 2 or 3, what you need to accommodate for that might need some replacement, so that you can add these costs, which is a good thing. So it can happen to you, but you are prepared well in advance when you go through this process, where people tell you, this is what your costs are going to be, this is what you need to consider, and be aware that this might happen going forward. You might need to fix up the basement, or you might have some damp issues, and they pick these out. They can tell it, and they can, and you would know, but you do need to be aware of them.
You bring up another good point in the process that people don't often think about. It's there's something called a conditional financing offer. So it could be conditional based on inspection. It could be conditional based on financing. So when you do purchase a property, we'll often suggest it to clients, or we'll suggest it to their realtors if we've spoken to their realtors before, that when you do buy a property, you set a 5 to 10 day period that is, the offer is conditional based on something. So if it's based on the conditional for financing, it means that you could actually get a mortgage. So if you can't get approved during that time, you could say, okay, I'm stepping away from this home, I'll get my deposit back. If it's conditional on inspection, it means that if you're buying a home and it looks great because they put up some drywall and they painted some rooms, but deep down it looks horrible and you have an inspection and it's just not the home you want to purchase, it protects you against any of those bad situations. So that's something that we often suggest to our clients. Is we suggest more of the conditional financing. A conditional inspection is something that is totally up to a client's perspective if that's something that they're not too sure about the property.
Yeah, but we've heard it from many people and yourself saying, do that inspection. It is worth your while, and it was. So that's where the great advice comes in, which is good. You need to know these things. One of the things I wanted to ask you around was self-employment. We've got lots of people coming over. Is the process if you're self-employed different? Do I need to kind of prepare documentations in advance? Would it be a different process?
Yeah, so if you are self-employed, generally they'll look for at least 2 years of tax forms in Canada. So it's unfortunately, even though so many more people are becoming self-employed across the world, our system is still not totally set up properly in Canada to recognize that. And it is because of wanting to be low risk in these situations. So the way our self-employed model works is, no matter what it is, you're going to need at least 2 years of tax forms in Canada, and they'll be a T4A, T1 General, and NOA, which are the tax forms, and they'll average out your 2 years of income to get an idea of what your affordability is.
Okay, so it's fairly simple process. Get your 2 years and then get the process going. Yeah. So the last question I've got you is, we now getting ready. What documentations do I need to bring with me if I want to buy property? If I can prepare before I leave my country of origin, what can I bring with so that I don't have to go back and try and get that documentation? And what documentation would you ask for when I'm here, even if it's for a period of time?
Yeah, even though you might not need it, to your point, Mel, it's always great to have that stuff available. So the first thing I would say is your tax documents for even 5 years back. The more, the better, of all your tax documents. I'd also get bank statements. So having your bank statements available just to show where your money is. So one of the big things that lenders will look for here is they want to make sure that there's no money laundering happening. So if you are taking money from South Africa or whatever country you're from and bringing it to Canada to put towards your down payment, it will need to be in your bank for at least 3 months. But they might say to you, okay, I want to see the paper trail. I want to see which bank it was in before in South Africa and how it came into here. So having your bank statements and having just documentation of where your money is really important. Any credit type of history you have is also a great thing to bring over. Those are probably the key things that you're going to want to have available just to make sure that you stand in good order throughout the process.
That's great advice. So we know what to bring with and to have those. And those documents will be used in different purposes as well. So you might as well just bring them with, have them with you, and you know when you want to buy property that you can get on because you don't have to scramble around getting all that documentation. Mm-hmm. It's been great. Jesse, you've given a whole whack of information. It's been amazing. I'm going to put your information onto when we launch this. There will be your website will be on there. The guys can reach out via Homewise, or they can reach out via the Howzit platform and we can chat. There's definitely more information coming through, but thank you so much for spending the time with us and all the best. Thank you so much.
Thanks so much, Mel. Great talking with you.